So the big question is this: how do investors like us who don't have a PhD in finance or millions to start investing, how do we grow our bank accounts to build real savings in retirements and yet still have the time to do what we really love? That is the question, and this podcast will give you the answer.
Hey guys, well, today is very exciting because the Fed has announced their rates. Everyone's been chilling out. And now that everything's gone through, there's a lot of stuff that's been clearing in the dust. And it's just kind of interesting to talk about it because these are sort of the things that the Fed does that no one really notices or worries about. But in reality, they really affect long-term market performance. Bonds and the rates of return on those bonds are really an extremely important factor when you look at how your long-term fund is going to perform, and also the quality of current U.S. market indices. A lot of the time, you're going to start to see some serious problems emerge in any given sector the instant that those bond funds start to, or even just U.S. Treasuries, start to inverse, and an inverted yield curve is what they call it. And the really interesting thing happens when you'll actually, usually the way it works is you buy a bond and you spend, a couple of years in the bond. And a lot of times people will use them when they're nearing retirements or savings goals, not because they're high yielding necessarily, but more so because they're particularly safe investments. And of course, they have an actual yield besides in that counters inflation, right? So, inflation every single year, your dollar goes down 2% on average in purchasing power. So the way that these guys work is with bonds is you'll lend them money, you'll lend a company money, you'll lend the government money, and they'll just pay you interest on your money for a set period of time. So with most bonds, you'll have them set up in a 10-year, 5-year, 2-year, 2-month. There's a whole wide range of time periods you can use for your bonds. And the time range that you use just depends on when you invest. But usually, you're going to want to use those shorter time frames. Those shorter time frames are going to align you close to your savings and retirement goals, since you usually only use them once you're pretty close to those goals. So, with that said, these bond funds are important, and the Treasury is important because the Treasury is such a huge consumer of debt, thanks to the Treasury bonds that they give out. And the Treasury bonds are essentially the baseline for the U.S. bond market because the U.S. government borrows, so much money every year that a lot of the times whatever they're paying for investors is what the market rate will circle around, because the government bonds are actually guaranteed by the full force of the federal government, right? So at the beginning, bond rates wouldn't really matter, but after the crash, and especially the establishment of the U.S. as such a major economic powerhouse, thanks to the Federal Reserve, which, as we talked about the other day, essentially just writes off money like it's no one's business. These guys can basically borrow all the money they want, and because of that, they establish the rates for the whole bond market. And in a normal bond, you'll get rewarded more the longer you lock up your money, and in a shorter term bond, you get rewarded less. So you might get 1 to 2% interest rate for a 6-month bond with the government, which is safer, maybe like a 2 to 3 plus in corporate world. And those corporate bonds, instead of lending to the government, you're actually lending to an individual corporation, like a company, right? Like Starbucks, Apple, whatever. Those guys are borrowing money from you for a certain period of time, and at the end of the time period, they'll actually return the cash to you. And then there's a whole lot of diversification that goes along with that. So with shorter term bonds, you'll see stuff around the lines of a couple percentage points in current market economies. And then with longer term bonds, you would get a little bit higher, maybe 3, 4, 5, 6, 8%, something like that, depending on the risk level associated with the bond. For government bonds right now, those 30-year levels are at about 3%. Historically, they've been crazy, right? They've gone up to 50%. I mean, well, not that high, but like seriously high levels before that are just insane looking back, but at the time they were seen as normal. So anyway, bonds, the rates that the Treasury has been paying have been going down significantly all the way up until the 2008 housing crash. And then they basically just hit zero to try to help the economy restabilize. And that was a huge change, because at that point, people really started to realize that, wow, bonds kind of like suck for long-term investing. And now you have a lot of people that flock into equities because equities are the historically proven better performing asset. So if the longer term bond yields a lower return than the shorter term bond, so the shorter term bond actually pays you more money than the longer term bond, that's what's called an inverted yield. And then the treasury bonds have done that historically, I think 7-8 times, and every single time that the government does that, every single time that the treasury does that, the stock market has crashed and entered recession, with an exception of one time in like 87, I think. But every single time it's done that, and I talk about more in the book if these numbers are off, but it's about 2 years average, maybe a little bit less, maybe a year and a half, until the stock market enters a recession. So these inverted yield curves are really, important things because there are gains during this time period. I think average return for that time frame is about 20% in indices. But you got to remember, these inverted yield curves are literally indicators for essentially the entire economy reversing and a recession coming, which is it's bad stuff, not good. So when we talk about this stuff, it's important because these inverted yields caused by the treasury can literally dictate the performance of the entire economy or the stock market. So with that said, the Federal Reserve, they control the rates on everything, right? They're the official government power, and they'll say exactly what they're going to pay. So the Fed chairman was a new guy. He came in last Christmas, his first hearing, I believe, and essentially gave everyone this outlook that interest rates were going to rise a bunch, and it freaked everyone out, man. It really was a serious problem because in December, very end of the month, this guy says that stock market tanks. Everything was awful. Everything basically just crashed. In the indexes, the indices went down, and then a lot of the stocks pretty much went down, just because of the way the market reacted to that news, right? In the short term, it's like a couple months down, and now it's been 3, 4, 6 months now, and now we're hitting new highs. S&P is at high levels. You never really know, when it's going to peak. No one knows, right? It's just you just play it. Thanks. To be part of the long-term game. But anyway, we're hitting new highs now. Everyone's rallying, and portfolios are up huge. But the important thing to realize is the long-term influence of news versus the short-term influence of news. So 2 days ago, the same guy comes out. It was his second meeting. He learned a little bit after the first time and realized, hey, I gotta chill out a little bit with the way we're handling these rates. So what he did was he did a lot better this time, and just made everyone chill. Everyone's good news. All the stocks went up yesterday, maybe 3, 4, 5% in my own portfolios. I don't know how much the market was up. Maybe it's up a couple of percentage points. And those percentage points, those were killer, right? That's all that matters. Is just figuring out what your net percent return is. That's when you're going to figure out exactly how to crush it in the marketplace with those long-term portfolio returns that are based completely on analysis of percent gain over time. So with that said, you're up a couple percent yesterday, and today everyone's bouncing down, and the market is just going down just a little, chilling out. Stocks down a couple percent in the morning, but then, get this, new highs, everyone's excited, the world's the best, and actually now I think we just hit another new high. So the market went up a lot, and then it went down a little, and went up a lot. And the point is, you just really can't judge that kind of stuff. It's tough to predict because, you're looking at collections of thousands or at least hundreds of stocks. With most major indices, are 30 at the low end on the Dow 30, which are just all talked about in the book. But the point with those is that you've got to put into perspective how important news really, really is. So what didn't happen today was the yield curve did not invert. The yield curve very rarely inverts, like I said, because that causes usually a market crash. It's not good. Not necessarily causes it, but it's like a predictor, an indicator, whatever you want to call it. So because of that, the Fed is not very prone to actually, let those happen, because when they happen, they get a pretty bad rep in the office, just because it's not good news for anybody when the whole market thinks it's going to reverse. So that didn't happen, right? 2 days ago, he closed on board. He says rates are going to be stable. They'll do a little bit more, a little bit less. They'll just make it work. and everything's okay. So in the short term, people thought it was awesome, that was great. In the long term, though, it's not necessarily a big deal because it wasn't, market-changing news. You might look back at it in like a couple years and look at the holistic trend of bond performance, which is awesome. That's a great thing to do. But right now, it's just news, and that's what I think a lot of people get fed up just a little bit too much about. And I think I read a whole chapter about this crap because it's super important. News is like not really what moves stock, and it's not really what you want to worry about. You want to worry about like buying and selling pressures and technical patterns and indicators and setups, because those are really the more reliable ways to understand the fundamentals, like what's actually going to happen to a stock, based on not necessarily what people think is going to happen, but like what actually happened. Where was the price, right? That's going to indicate so much more for the company than what the news anchor thinks. And a lot of time people get super caught up. They're watching news all the time. They're like, oh my god, stock market's up, stock market's down. Oh, gotta get out of the portfolio. I can't believe I'm in this. Gotta, change your balancing or whatever. And a lot of people, they get sucked into that, and it's bad. It's really bad, because if you look, and I remember where I saw this study, they were looking at like actual index returns over time, which were just colossal. They were killer. Stock market indices, as we talked about yesterday, are just phenomenal. They're insane. They're great. Biggest economy, it's just insane. But if you look at individual portfolio returns from a lot of independent money managers and individual investors, what this study actually found is that the average person performed in the long term 2% or 3% worse than the long-term indices, purely because of the way they manage their money as an individual trying to time the market. Now, I don't want you guys to think you can't time stocks, because you can 100% time stocks. That is the entire principle of 9 to noon trading. But timing the market, the collection of hundreds and hundreds of stocks, that alone is extremely, extremely difficult. And no matter where you start at, you're essentially always looking at this huge, huge monster that is just, it's just really, really difficult to time with most metrics and indicators and all that technical stuff. I mean, you can guess, but a lot of the time, you're just going to end up flat wrong or confused, because the market doesn't follow, what people think it will do. It does its thing. It's a collection of so many companies. It's a reflection of the economy. It's a reflection of psychology. It's a reflection of the entire United States, or whatever country the index is for. And that's not really something that you can usually time. Those are usually influenced by greater macroeconomic factors that change, really, really slowly, really fast. But you're not going to have individual trades based on that, which is like why most people, they just can't really time the market, because the market isn't like a stock, right? Stocks can change overnight, but the market is just so many people that it's just not going to happen. So back to the story, right? So the Fed chair guy, right? He's putting out this news. He's telling everyone what's up. But in the long term, what he says today, what he said 2 days ago, isn't really going to matter that much unless you look at historic trends, and then you're basing some of your, price predictions or analysis factors on those long-term trends that are going to change, not really in a night, but maybe over a couple years, a decade, something like that. Like bond interest rates aren't going to change very, very much overnight, which is totally cool. And that's why a lot of the time you just you don't day trade index funds, you don't trade bonds usually. You can swing trade some really specific ones, which I talk about in the book. Like if you want to pick a very specific company's high yielding bond that may have more risk, like that's cool. You can totally do that. But a lot of the time, finding like individual securities in the bond market, it's just not a good use of time compared to using that same time for 9 to noon trading in equities or stocks, basically. It's just a much higher percent return. You're looking at like on the high end 10% versus in the market, hundreds and hundreds of percentages on 9 to noon stocks. So what do we learn today? We learn news and principles. Look, guys, please. I understand a lot of people, they like to watch, CNBC or Fox News or CNN or whatever. But like, don't let that stuff affect your investing mentality too much, because with most investments, the news is awesome. It'll have temporary changes, but if you're looking at a long-term investment, then it really doesn't matter. Especially if you're going to hold a stock for 10 years, how they perform one quarter, how they perform with one given analysis, how they perform with one given stock valuation based on an outside performer. It's not going to change, the validity of a company that much in the next, 4, 5, 6 years, because those things, they don't just change overnight, right? Like Disney isn't going to stop opening theme parks tomorrow because of some piece of news that says, I don't know, some corporate. Like, they don't really care. It's their job to do their job, and that's why when you're looking at your long-term analysis picks, you're considering some of these greater factors that influence stocks like, bond rates, which, again, not really a solid investment for most people until they get to their retirement age, until they get to their savings age, because they're just historically significantly lower performers in stocks. And the best way to overcome that is to find, either stocks you believe in, indexes that are historically proven, or, create your own diversified portfolio, which is going to yield those high returns, next to, actually going full, going all in, and trading 9 to noon. That's really important, because I want you to think, what is it that the company is, if you're investing in specific stocks, which I highly recommend you do, especially in your long-term portfolios. Most of my portfolios, individual stocks, and no sector fund set, maybe a couple of Qs like the NASDAQ 100. But you got to consider too, the market timing given where you are, because you don't want to be investing necessarily in the riskiest funds when the market is really, really, really high. But at the same time, if you're going to invest in it for 40 years, then yeah, you know what? It's not a huge deal. You can do whatever you want, because you look at the time component, and you have so much time to actually, take the risk and have your return be at whatever level that you want. That a lot of the times it just doesn't make a huge difference in the long term, because you're able to take, losses as they come, and those losses are always going to come right before big gains. And those gains are the reason you're in the market, because the deal with it is, having the psychological relaxation, I think is a good word. Another word is discipline, to understand, especially with index funds or other long-term investments. This stuff takes time, right? You don't build an entire retirement portfolio in a weekend. Unless, you can plan it out. If all you're doing is buying an index fund or a combination of index funds, yeah, you can plan it out in a weekend. But you got to remember, that plan still takes time to execute. That plan still takes time to perform with. That plan is amazing. That plan is historically proven, and that plan will work in the long run based on how many so many people it's helped before. But there's always risk with it, right? There's never a guarantee. You always have to remember exactly what you're in, why you're in it, so that in bad times you know that you're going to be okay to chill out and hold the position, because you understand that it's for the long term. And that long-term growth, this is money that you're putting into your future. This is money you're investing in yourself. And that mentality is something that comes with time, but it also is really just a lot about discipline. You've got to be able to put the cash into your account, and then essentially never worry about it again. Always consider it part of your future, part of your retirement, part of your savings goal, because the instant that you start to think of it as yours, it's not, because you got to understand, if you're putting it in a huge collections of stocks, you just got to give that thing time to work. It's a little bit different mentality, especially for 9 to noon trading. If you're actively managing your portfolio, if you're swing trading, that's different. You can definitely, because the biggest difference is that with 9 to noon trading or swing trading, the stuff you trade is kind of rotating out. You're not in the same stock for 10 years. You might be in it for a couple months in a swing trade, maybe a year in a swing trade, or literally 2 minutes, 5 minutes, 10 minutes on a 9 to noon trade. It's just a totally different mentality and a totally different reality of gain potential because the difference between the two is really what you create in the short term versus using the short term to create the long term versus just going straight on that long term gain, right? And it just kind of depends a lot on where you are in the process. But you got to understand too that like you can control the process. It is up to you to find what works, and what works is you know, it's like just go hard, learn the material, learn the content, and then get out there and crush it doing what you love. I know we're almost at the end here, almost at school, but something that happened just a day ago. I was talking with a friend, and thanks guys. Oof. And this guy, you know, he was working, and I think if you're on my email list, you might have seen this story, which is awesome. You guys should definitely get going on that. I think you can join it like www.johnfwooten4.com or something like that. But the cool thing with it is this kid, he was in middle school, and he went out and he looked at the companies that were in his home, the companies that he used every day. And he went into the stock market. He's in middle school, and he had his parents open him up an account. I really wish, you know, he knew about minor accounts, but totally cool, right? So he opened up an account. He didn't know UGMA, didn't know UTMA, not a big deal. In his parents' name, and then he just buys the stocks around him, and buys the stocks that he loves, and he holds Netflix for about a year. I had Netflix in my portfolio too. Really great for them. And he makes like $500 in his whole portfolio. And it was so cool because all he did was go around his house and he found the stocks that his family used, or the companies his family used, and then he found their public stock equivalents and just used those as an investment. Like how easy is that? How cool is that? All you do is go out there and crush it, and it's super amazing once you really start to get going because it's so, you know, you find materials and you go through materials, a lot of it is just sticking to that discipline of putting the money in the market, and you know, all you have to do is create that wealth by, you know, establishing, hey, this cash, this market cash, this is not the stuff that we're messing with. Leave it alone and let it happen. And when you let it happen, that's when you start to see those superior results in the market. Because here's the deal, right? The market will not reward pressure. The market will not reward, you know, force. It's chill. It's gonna do its thing, and you gotta let it do its thing. But when you let it do its thing, you relax, and you understand that it takes time. I mean, you can be like this kid. He's in middle school. He's probably like 12. He's like 12, and he's got his portfolio doubling just because he let the market do its thing. All he does is let the American economy and the windfall of profits that come from it work for him to do his own work, so he's not actually going every day, and he knows how to crush it because of that. It's really inspiring stuff. I wish I knew about stocks when I was 12, because here's the deal, right? If you look at your performance in the long term, the most money you're going to make, at least in your retirement accounts, is going to come in those later years, in those last couple of years of your compound interest growth curve. And that compound interest growth curve, I mean, I talk about it all the time, but like, those last couple of years are so ridiculously important and so great for your growth, because that's when you start to see your entire savings, your entire retirement over time, as it's been growing. You can finally take that and put it in this amazing new spotlight where you've got, you know, your $4 million portfolio, whatever it is, that you've grown over time. It's not difficult to grow over time because you understand the concepts and fundamentals behind long-term stock market investing, or just investing in general in assets that are finally going to pay you cash. And you're making hundreds of thousands of dollars on interest in those last couple of years. And if you can add 10 of those, I mean, you're literally adding like another zero to your portfolio. It's insane. It's really great stuff to see those people doing it, and they just it's so great. So your job today is go out there and invest. All right, thanks guys. I really hope you found this valuable. Hope you're enjoying the Stock Market Secrets podcast, and have an amazing day. See ya.
Want more stock market secrets? If so, go get your free copy of my best-selling book, 9 to Noon. You can get your free copy plus $11,176 of unannounced bonuses it took me years to uncover completely for free at 9toNoonSecrets.com. Inside 9 to Noon, you'll find the top 38 secrets you can use to double your portfolio every 2 years and make upwards of 10% per trade daily.